So now we've left off, and so welcome back to part 3 now of our series on building a multi-year cash flow statement. So now we've left off here, having worked partway through our liabilities and so forth, and we're going to have to do a little bit more work around this, and then we'll show how to integrate savings into the picture. So I've got my credit card. I call this credit card interest. Okay, what I really maybe should be doing here is calling this my credit card payment. So let's call that my credit card payment now. And I don't want to change it on this sheet. I had that referred to on the expenses sheet. So I'm going to go over to expenses now. And I'm going to change that to credit card payment, because presumably we are paying an amount that includes some principal and some interest. We have a balance here, and we can see that that's the case. Okay, so what happens then is we pop back to our multi-year cash flow. Okay, and with my credit card payment and my line of credit payment, I don't want to be paying too much here. So this is where I'm going to start to sorry, I don't mean to have those in there. I did something earlier. Just get rid of those. And we're going to pop over to our credit card, and we're going to build out our credit card on this multi-year basis like we've been doing already. So we're going to build this out with the top 3 rows, where they're going to look just like we have our top 3 rows for our multi-year cash flow. And in fact, we can even do that back over here. And then we can copy those all the way across. So that we're ready with that credit card in all the years in which we might need it. Okay, and I've noted actually that I'm going to stop at row BT here from now on, or column BT, sorry. Again, I'm going to do my freeze panes here. And I've got Jeff's credit card balance. I've got Jeff's credit card interest. And there is a little bit of redundancy here. Okay, and I might be able to go and delete some sheets later on, or whatever the case is. I don't really mind that. And we're going to look at the change in principal for that particular year. That is, have we increased the amount outstanding on the credit card or decreased it? And we're going to do the same thing for Tina. So I've got his starting credit card balance, and I can just pull that off of my liabilities sheet. I've got an amount of interest that we're going to be paying, and I can base that off of the balance for the year times our interest rate, which we know is to be found on our data sheet. This is Jeff's credit card, so we're going to pull that off of Jeff's interest amount. Easy. Now we're going to deal with change in principal in a couple minutes here, and for Tina we're going to do roughly the same thing here. We're going to pull her credit card balance off of this sheet. We're going to pull her principal sorry, Tina's credit card interest, I want to call that. I don't know why I type principal in there. We're going to pull that off of our data sheet. Again, Tina's credit card interest at 22.9%. Now, I do want to make those both absolute references, so we're always referring to her credit card. Just with that F4 shortcut key again. And of course, these are all going to be currency amounts. So now we're at least with a starting point here. And I can see that what's going to happen with Jeff's credit card balance is that it will be equal to his balance from last year plus any interest. And then for now, we'll add the change in principal. We'll see where we end up with that actual formula. And for Tina, we're going to do essentially the same thing. And actually, we should just be able to copy that formula down here, and it should work out for us. So we might do change in principal here. I might change that to actually our credit card payments. That's what we're going to do here. We're going to do just credit card payments. That'll match better with the way that we're treating this. So we now look at the payments being made. And where did I establish the payments? Well, that was back here on the multi-year cash flow. So we've got an amount being paid towards the credit card. So we can go back here to the credit card. We know his payments are equal to that amount on multi-year cash flow. Sorry, but that's all the credit card payments. I want to break that out to Jeff and Tina's payments individually. And that's what I'm actually going to do. I'm going to separate out Jeff's credit card payments. And we're going to just insert a row here. And we're going to throw in Tina's credit card payments as well. Make that column a little bit fatter. And now we're going to pull Jeff's credit card payments from the actual liabilities sheet, which is where we saw, from the expenses sheet, which is where we saw this. And so we saw Jeff's paying $110 a month, so we can just pop back here. And we can put Jeff's payments at his monthly amount. And we can do that times 12. So all kinds of things we can do here in terms of this. Tina's payment is going to be based on her monthly amount. Also times 12. So now we know what Jeff is putting towards his credit card every year. We know what Tina's putting towards her credit card every year. And we can go back to our credit card now, and we can say, all right, we've got that amount. We're going to pull that off our multi-year cash flow. And Tina's payments are going to come off of our multi-year cash flow as well. So now we see what's happened here is that the balance has grown based on the payments. So now I can see what I need to do. I got to subtract that out. And I've got to subtract that out. And now we've got the credit card balance changing to keep pace with the changes in their situations. Okay, so I think we'll actually stop there. I know we didn't get to the concept of accumulation yet, but we'll do accumulation soon here. We have a little bit more work to do with our liabilities. Thanks kindly, and I hope you enjoy the next video.